Good morning, and thanks for tuning in to Stocks to Watch on BloombergQuint. I'm Mathew. My guest today is Dharmesh Kant. Thanks so much for joining me, and good morning, Dharmesh. The first update that I want to talk to you about is almost certain to have a positive impact, at least in the short term, on a number of stocks in the real estate space. The Maharashtra government has decided, as we know by now, to give the sector some relief by reducing the stamp duty by 3 percentage points to 2% on real estate transactions between September and December. And then that goes up to 3% between January and March. The question that I have for you is that the industry as a whole and some of these players in the space are sitting on quite a bit of inventory. Is this really going to push people to buy property? And which player in the real estate space that is going to be impacted, if at all, do you have a buy rating on?
Yeah, good morning, Alice. I think this will trigger a buy for the fringe buyers. I mean, the buyers who are sitting on the sidelines and waiting for a price correction. So they may have additional 2-3 percentage point more in the price reduction. So already, the real estate market is depressed. And if you are sitting on the table to negotiate a deal around 10-15% kind of a price correction you are getting, on top of that, if you are getting 3% more, so on a 1 crore property, around 3 lakh rupees you are saving. So that's a significant amount, just trigger the buy coming the way. And from government point of view, I think it's a revenue neutral. Whatever they lose in the form of stamp duty, that may come back to them in the form of taxation paid by the real estate companies if they report profits. But the market as such is pretty depressed. I don't think this is going to create a big demand for real estate anyways, because economy is in the downturn. Pay cuts are already there, and affordability of buying outright, I don't think so. The very thesis, I find it very strange that work from home culture will trigger a buy for housing sales. I mean, where it prohibits a rental or a person who is staying on a rented apartment, he cannot work from home or he cannot use a laptop. But at the same time, just consider the yield you are getting. So if you are buying a property in Mumbai, the rental yield is not even 3%, whereas FD rate is 6%. And there has not been any capital appreciation in the last 5-6 years, any significant capital appreciation. And real rate is in fact, real return is in fact negative if you take the inflation into account. So either from investment perspective, even for rational people who are earning and who want to own a house, doesn't make sense if they are stressed as of now. So I don't think this is anyways a big trigger. We may get a flip today. I mean, trading jump of 5-10% can be there, and if at all one has to allocate the funds to real estate, I think overall reality in the Mumbai region remains the top pick, followed by Godrej Properties and then Kolte Patil.
Okay, so you're very certain that this is unlikely to have a major bearing on sales going forward. If at all there is some announcement from the center for real estate as a whole, there could be some benefit. Let's go to the second stock, which I thought was an interesting one, Dharmesh. This is Hindustan Aeronautics, and it's been a stock that's been in focus because of the announcement that came in with regard to procurement from the local defense manufacturer. So that was a positive. And also, especially because this time around, there's going to be a separate budget for defense. But the latest update is that the government is going to sell up to 15% stake via OFS. The floor price for 10% stake sale is at 1,001 rupees per share. And that's a 15% discount to the closing price yesterday. They have a green shoe option to acquire or to sell another 5%. What do you think of this OFS? Do you have a positive rating on the stock? It's done pretty well for itself. And would you say that investors can use this as a good opportunity to buy?
I think it makes short-term investment bet sense if you an investor if is going through the OFS route, because the discount is 15%. It's a mandatory SEBI requirement because the government anyways has to bring the stake down to 75%, and it is in line with that, rather than any revenue generating stream for the government. And if you look at local manufacturing, Hull has been actually doing that for ages, be it the MiG-21s or the Sukhoi 30s, Jaguar, and the helicopter Chetak Cheetah, and it's primarily a repair and maintenance and overhaul kind of a company. Once we get an order procurement from overseas, a country like Russia, earlier it was Russia, now Rafael deal is done with the France. So post after a couple of years, they try to build it here. So that's the very basis of or the genesis of this company. Nothing indigenous in a remarkable way has come out. And I mean, top line is very, slopey kind of a top line. You cannot expect 20-15% kind of a CAGR over a 5-year period. Budget is always there, Alex. But the point is whether the government has the bandwidth of revenue to fund that budget into actually actionable plans. So announcements are fine, but I find it very hard and tough for government to, cough up money to get it in a big way. So 15% discount is good enough. And I mean, if you have a 5-year kind of a horizon, so margin of safety is high. It's trading at 15, 14 price to earning multiple. The stock price has run up of late post March correction. It has almost doubled from there. But still, if you have the mid 20 ROEs, return ratios are fine, balance sheet is very clean. So I think OFS should be followed by investors to park some money into it, and maybe if they want a good dividend yield and willing to wait for a time being, so it's a doubler to my mind.
Okay,
But it's
that's an
not
interesting.
exciting.
It's not exciting. Okay, that's fair enough.
Yeah.
The third one, and I'm doubtful as to whether you will find the third stock exciting either. This is IGL that we're talking about, Dharmesh, and the results came in yesterday. They were understandingly a little bit muted, perhaps on one end because of COVID-19. The revenue has come in at nearly 60% lower at 638 crore, and particularly, I thought that the margins were depressed. They were estimated to come in at 18.8%, but they've come in at 13.1%. And as a result, I think the net profit is down nearly 90% at 32 crore rupees. So, one, what is your rating of the numbers? Do you think that it was a significant miss in terms of what was estimated? And now that you've seen the players in the gas distribution space put their earnings out, which one would be your pick, if at all?
See, Alex, to be fair to analysts, I mean, estimates should not be given importance to because nobody has any
Fair enough.
clue how the numbers are going to pan out in Q1 or FY21 because of the lockdown. So it was a complete lockdown in the month of April. And if you look at, the top line breakup of IGL and MGL, 73% is from the CNG part, which is through automobiles. So CNG was almost for the month of April, it was totally shut. Even May, it was hardly any movement across the country. So and June, some movement started. I mean, June was a catch-up kind of a thing. So the margins had to be, depressed because the expenses were already there. The maintenance and everything, the cost company has to incur. So I won't give much importance to the number of Q1 for even for all the I mean, city gas distributor companies, be it IGL or MGL. They have a good return ratios, mid 20 return ratios are there. And IGL on the price earnings ratio, it's pretty high. It's on the higher side of around 20-25, whereas your MGL is around 14-15. But Alex, the main point to answer here is because 73% you are getting through CNG and PNG is around 27% of their business. So going forward with electric vehicles coming in a big way, and it's both commercial as well as personal mobility electric vehicles, be it bikes or small buses and trucks. So this CNG will take a big challenge from electric vehicles, and maybe they have to shift their revenue. And PNG is not an easy business because see, IGL is located in Delhi and it's a plain area, so adjoining states they can still lay the pipelines. But for MGL being in Mumbai and Raigarh, Pune, it's a hilly terrain. So a gas pipeline, laying off pipeline and the maintaining of pressure to supply the gas, which is already 1/5 of the speed of, if you are fueling the liquid through the pipeline. So it's a tough business for both these companies. I would prefer, in fact, Petronet LNG compared if you once wants to, invest in this sector because Petronet LNG again has a bit in, return
Right,
ratios. At the same time, it's in B2B business and its
right.
price to earning multiples is also low. So that's a better bet.
Fair enough. I think that's a very comprehensive view on the gas distribution space. Thanks so much for that, Dharmesh, and indeed for the
Thank
other
you,
views that you
Alex.
shared today. Thanks so much, dear viewers, for tuning in today. I hope that this helped you as well. Do stay tuned.